Hi, I'm Matt Kousinen from Ellis & Associates Wealth Management. Thank you for joining us today, and welcome to our second webinar on planning strategies for volatile markets. I will be moderating today's session, and William Ellis will be our presenter. Similar to episode 1, we are going to try to keep the length to about 20 minutes, plus some time for questions. Feel free to type any questions in the chat box during the session, and we can try and address them as we go or at the end. The webinar is being recorded, and we will send you a link afterwards so you can view anything you missed or to pass it along to someone who might benefit from listening. We will also post it on our website so you can view it there anytime. There, you can also view our first webinar, the Lifeboat Drill. Our session today has 4 sections. The first is a recap of the current market yields available to investors. The second details two different cash flow investing strategies. The third is the impact that volatility in the market has on these strategies. And finally, in the last section, William gives his insight into why cash flow is king in volatile markets. Now on your screens is a slide we refer to a lot. William, can you give us a quick recap of the estimated market yields available right now?
Sure, Matt. Estimated market yields point to a market of 2 extremes. One extreme is the paltry yields available on anything with a guarantee, things like cash or government bonds earning 1% to 2%. At the other extreme, cash flows generated by select growth businesses are very decent, 10 to 11%. If you compare the interest rate yield on long government bonds to the free cash flow yield on select growth companies, the spread is currently about 8 to 9% between these 2 extremes. And that's before considering any future growth of cash flow or considering the capital gain possible from owning growth businesses. That's a substantial spread. Now, in between these 2 extremes on this slide, you'll notice our core investment, the dividend portfolio.
So here we have highlighted the dividend portfolio. Can you tell us a little bit more about this strategy?
Well, the slide indicates the current economics of this dividend portfolio, which is our core investing strategy. Overall, the businesses we own generate 7 to 8% free cash flow yield a year. Now, just over half of that cash flow is generated by the businesses and paid out to shareholders in dividends, and the remainder is retained and reinvested in the business. The yield right now is 4.25%, which is decent. Historically, the dividends received have increased on a regular, consistent basis and at a rate growing faster than inflation. For example, the average increase in dividends in our portfolio in 2012 was 6%. And 2011, the average increase was 7%. That's the income side. Now, regarding the capital side, the capital value of the dividend portfolio has increased too, and we expect it to increase over time. But this part of the investment return, the capital side, is uncertain and subject to the volatility of the stock market. In good years, you get your dividend income and some capital appreciation. In bad years, you get your dividend, but you have to endure a decrease in your capital value.
Now on your screens, we have highlighted the growth portfolio. William, can you explain what investing for cash flow means in the growth portfolio?
Well, growth companies pay very little regular dividend income. It's all about retaining the cash generated to reinvest in the business, to pay down debt or to buy back their shares, and as a result, increase the capital value of the business rather than to pay dividend income. And at this point in time, investors have very little appetite for investments that don't provide immediate income because they can't see past this current period of uncertainty. As a result, select growth businesses trade at very attractive prices. at current prices, the businesses are generating 10% plus free cash flow yields.
So, William, why shouldn't I put all my money in the growth portfolio?
Well, that's a good question, Matt. You could, I guess, and I suspect that you do quite well. The numbers look attractive, but it depends on your age, stage, and financial situation. As you enter your retirement and pre-retirement years, your focus changes to how you live off your capital. The challenge with the growth portfolio is that an investor receives little or no immediate cash flow as dividend income because these are growth businesses. The earnings are there, but they're being reinvested. Investors in the growth portfolio need to patiently wait and need to be in a position to patiently wait for an opportunity time to harvest the capital gains in the future. When that will be, we don't know. The businesses are good, the prices are right, but very little cash is paid out to shareholders. If more cash is required, and if you are fully invested in the growth portfolio alone, you'll be forced to sell shares of these growth companies into the market. Sometimes it's a favorable time to sell, and often it's not.
So, William, I see we have a question here in the chat. Would you like to answer that now or at the end?
Well, the question here is, what is the historical spread between long-term bonds and growth stocks? Great question. So if we take a look at that separately in terms of what our historical long bond rates, we are now at 100-year plus lows on long bonds, south of 2.5% here in Canada. Very, very low, never been this low, and that would be the case across the world on long bond rates. Typically, these can range, if you go to 14% 30 years ago, that's a difficult question. The bond yields have come way down. These growth stocks are typically around 6 to 8%, and that's in that sort of range. So we're much more attractive, but the spread is enormous, primarily because of the low interest rates.
Okay, so moving on now to the impact that volatile markets has on people looking for their portfolio to fund their retirement. How does this slide illustrate the impact volatility has on an investor who is investing for income?
Well, if we take a look at this slide for a minute, there are two things graphed. The blue line plots the ups and down movements of the TSX over the past 20 years, and the gold bars graph the dollars paid in dividends by the TSX companies each year over the same period of time, the last 20 years. Now let's just take a look at that and think about it for a minute. The blue line and the gold bars are graphing different measures of the same asset, the TSX index. One is the price, the other is the dividends received. The blue line, market value, is scary. The gold bars, the dividend income, is stable. So what was the question again, Matt?
Yeah, how does the volatility impact an investor who is investing for income?
Well, it's never easy, this volatility, but it's nice to get your dividends to pay the bills. The market swings and the turbulence is often way out of proportion with the change in the underlying value of the businesses and their cash flow, and especially as noted here, the change in the dividends being paid. This can present an investor with opportunities.
So let's take a look at a specific business that those on the call might be familiar with.
Yes, that's TransCanada Corp. It holds a special place with me because I worked there for 4 summers at their head office when it was in Toronto in the accounting and treasury functions, and that helped pay me through university. And when I worked there 30 plus years ago, it was a staid conservative pipeline company, and it remains so to this day. You'll notice that TransCanada's share price noted here since the year 2000, that if you look at the markdowns, that they've sold off 10, 15, 20% a number of times, and that it sold off in 2008 by 25%. Some of these sell-offs were no doubt warranted by economic or company-specific circumstances. However, underneath the noise of the share price, what we find is a business generating a fairly consistent growing cash flow, as indicated by this slide, which shows the portion of earnings paid as dividends each year. This slide is for the same period as the previous slide, and a lot of that growth in dividend was front-end loaded because there were two dividend increases in 2001 and 2002 that were for 10 cents each increases, with 6 and 8 cent dividend increases since then. You really get the sense that the board of TransCanada likes to deliver regular dividend increases, don't you? With 8 cents a share increases in each of the last 6 years. The result is that the dividends in 2012 are more than double 2000 levels, giving owners a decent pay increase after inflation is considered. Now, I want to warn you here that this isn't a buy, hold, and forget about it investment. While you'll notice from this slide that dividends have doubled and then some in the past 12 years, if we go back to the previous slide for a moment, the market price of the share has almost quadrupled in the same period. TransCanada is a great business, and it can continue to earn a return on invested capital and pay dividends and increase dividends, but at this point in time, the price the market demands for this business is expensive. Anyway, the main takeaway here, though, is that this investing in businesses that can grow their cash flow, that can provide great dividend income stream along the way, and set up for additional capital gains.
But why? William, can you, in your opinion, tell us why cash flow is king in volatile markets?
Well, investors, especially those in retirement and approaching retirement, need cash flow, regular cash flow growing to keep up with inflation, and not just cash flow this year, next year, and the year after, but cash flow potentially 10, 20, 30 years down the road. So they have to have funds coming out of their investments to support their lifestyle. That's cash flow. Cash flow is king. And that's why they need to focus on cash flow generated by their portfolio. Cash flow from bonds today is inadequate. 20 years ago, if you had $1 million, and this is referring to the previous question in a sense, if you had $1 million, you could earn $100,000 a year in interest from government bonds. Today, you earn closer to $20,000. If you want to earn $100,000 in interest, you need $5 million. With no inflation protection and high rates of tax on interest you receive. So really, bonds don't provide you with the cash flow you need today. The cash flow generated by growth businesses right now is very attractive, but the cash flow is generated inside the business. We believe that growth businesses deserve a place in portfolios. The challenge here is that the businesses don't pay out a sufficient portion of the cash flow they're generating to meaningfully fund cash flow needs that you as an investor or retiree have. And there's often a disconnect between what these businesses can be sold with for at any point in time and what they're worth. You don't want to have to make up a shortfall in cash flow by selling capital assets at times when the market isn't paying you a sensible price. So, growth businesses make a lot of sense as longer-term investments, especially to protect against inflation, to defer taxes, to grind down the tax rate. But the core portfolio here for us remains our dividend portfolio. And in the dividend portfolio, you get a decent cash flow. It's lightly taxed. The cash flow is growing faster than inflation. And the dividend is high enough that you are less likely to need to sell off your capital to meet your cash needs. If you do need to sell, the price of these companies is considerably less volatile than the market in general, so that you take less of a hit if you have to sell in weak markets. cash flow is king because it generates enough cash. If you generate enough cash flow from your businesses, rather, to meet your requirements, you're no longer threatened with having to sell at an inopportune time. Rather than possibly be a price taker at the worst possible time, you can become opportunistic.
So this is a quote we introduced in a seminar a few months ago on earning income in a low interest rate environment. And we think it fits well with this topic on cash flow focused investing strategies. To give a little background, John D. Rockefeller, the patriarch of the Rockefeller family, was born in 1839 and died in 1937. He rose from humble beginnings and in 1870 founded Standard Oil Company. He quickly became the world's richest man and the first American worth more than $1 billion. Adjusting for inflation, he is often regarded as the richest person in history. Although his company was dissolved after being considered a monopoly, Rockefeller retired in 1897 and spent the last 40 years of his life collecting and reinvesting his dividends. This quote is over 100 years old and shows that even back then, Rockefeller knew he must focus on cash flow, and that cash flow is certainly king. William, anything you can add about how this relates to today's marketplace?
Well, Mr. Rockefeller said it very well. If your capital generates sufficient income for you to live off, you're in a very good situation financially. You're less concerned with the day-to-day, month-to-month, year-to-year value of your capital, and you can enjoy spending your income.
So I guess the challenge is to have enough capital to be in that situation. And our next webinar, entitled What's Your Number?, addresses this issue of how much capital do you need. So we'll now begin to answer questions from the chat. And William, the first question I have here is, are the dividends guaranteed?
Well, Matt, that's an important question, and the answer is no. The dividends are not guaranteed. And for that matter, the dividend increases are not guaranteed either. The businesses, however, have consistently made money and very consistently paid out and increased dividends. Corporate boards are very hesitant to decrease dividends. We're comfortable that, especially as a diversified portfolio, the dividends will continue to be paid in the future, with dividend increases exceeding inflation. But they are not guaranteed. It's a good point. If you want guaranteed, then, you know, if you're comfortable with the guarantees that are promised by the Government of Canada, then your cash flow yield is 1 to 2.5% range, depending on how long a bond you buy. And we think that the step up in return that you receive from investing in a dividend portfolio compensates us well for the additional risk we take on. Thanks for that question.
Okay, the next question I have here is, what age group is this cash flow investing strategy right for? Is it only for those just entering retirement?
No, really, all age groups can benefit from this. We might, in different age groups, have different mixes. Obviously, the older you are, closer to retirement, or whether you are in retirement, then you're more likely to have a higher emphasis on need for cash flow. Cash flow is especially king when you need it. When you don't need it, then it's less of an issue. However, we think there's a place for the core strategy in everyone's portfolio because it makes good sense. Returns are decent. It protects you from this new normal that we've been speaking about, this challenging time where economic growth can be slower for longer, and particularly with exceedingly low interest rates, it's very attractive. You know, the other thing too that I should mention too is how much you invest in this strategy also depends on your personal comfort level, and that just because you are younger doesn't mean you're necessarily more aggressive. So if you are, you know, a conservative investor, this seems to make an awful lot of sense for us. And even a younger person may be more conservative than an older person, and so it's a good portfolio for everyone. The mix depends on each person, though.
Okay, well, there's no more questions, so thank you for joining us today, and if you would like to discuss today's webinar further, please feel free to contact us at 416-969-3190. Thank you, and I will now be ending the session.